Welcome to Financial Reporting and Analysis, an introduction. My name's John Bone. I'll be with you for this particular reading. Okay, so financial reporting and analysis is our biggest area of the Level 1 syllabus, so it's going to be very important that we perform well here. We've got 4 study sessions to cover. First study session is really an intro, then you've got your 2 main study sessions, and then a little study session ending up looking at financial manipulation. So let's start off with financial reporting analysis and introduction. Let's have a look at our first learning outcome. Okay, so our first learning outcome is asking us to describe the roles of financial reporting and financial statement analysis. Okay, so let's have a quick look at this IASB conceptual framework. First of all, let's point out the key notes on this. The objective of the general purpose of financial reporting is to provide financial information. Well, no great surprise there. About the reporting entity that is useful to existing and potential investors. Okay, so here's the first thing really to notice. It's not just the current shareholders that this information needs to be relevant to, it's also potential investors. So we're talking about shareholders, investors, but we're also talking about lenders as well. So people that are likely to be giving loans to the company, people that are likely to be buying bonds from the company. And it also mentions other creditors. So who are these other creditors? Well, one example, for instance, might be tax authorities. So, okay, we're trying to give them information that is going to be relevant for decision-making purposes. So again, there we go. The key point there, it's all about giving them information that enables them to make decisions. So when we look at what those decisions are, there's no great surprise. It's buying, it's selling securities, it's holding equity, and both debt securities. So buying and selling both debt and equity, settling loans and other forms of credit. Okay, so that's the role of financial reporting, to provide this information. And of course, the role of financial statement analysis is to analyze that information to make these decisions. So this is our learning outcome extended, talking about the role of financial statement analysis. Using information in a company's financial statements along with other relevant information. Okay, so we're going to use the information in the published accounts, but we're also going to combine it with any other relevant information, such as information about the industry, information about the economy, to make economic decisions. So that's our key point. We're using this information for decision making. And as we said, it could be evaluating whether a security, whether an equity looks like a good investment. It could be looking at takeovers and mergers, i.e. acquisitions. It could be creditworthiness. So it covers a lot of areas that we'll be talking about within CFA. Obviously, evaluation of securities is going to pop up in equity analysis. Acquisitions we cover in corporate finance. Creditworthiness, of course, relates to lending the company money and therefore is covered within fixed income. So all areas that the CFA concentrates on. So notice we're going to evaluate a company's past performance. Obviously, the financial statements give the results for the company. So in other words, we're seeing ex post information here. But also, we're looking at past performance and current financial position. Past performance is really covered by our income statement. That's its role. It's looking at how the company performed over a period of time. Current financial position is really covered by the balance sheet. It's looking at everything the company owns, everything the company is owed, and essentially everything the company owes as well. So we're looking at past performance and current financial position in order to form opinions about the firm's ability to earn profits and, of course, generate cash flows in the future. Now, earn profits, we're talking about, therefore, its ability, its profitability going forward, generate cash flows in the future. And of course, these cash flows might be used to invest in new projects. They might be used to pay down debt, etc. And they give us flexibility to respond to the uncertain events. Generating cash flows, of course, again, is a key part of equity analysis when we look at free cash flow, particularly in the Level 2 syllabus. So our LOS now talks about describing the roles of key financial statements. And the very first financial statement we get is the income statement. Now be aware the income statement has various alternative names. So US phrase tends to be income statement. Income really meaning profit, so profit statement. Within Europe, we often refer to it as a profit and loss account. Other names that you might hear it being referred to, statement of earnings, and you might hear it being referred to as a statement of operations as well. So that's income statement, profit and loss account, statement of operations, statement of earnings. Key point about your income statement is it's really trying to summarize performance. Notice it says summarizes the events over a period. Therefore, we refer to the income statement as being a dynamic statement. Now, all that dynamic means is it spans a period of time. And in the income statement's case, that period of time is between balance sheets. So between the last balance sheet and the current balance sheet. Does it always have to be between balance sheets? Well, the answer is yes. Typically, balance sheets, of course, are the space between balance sheets, the interval between balance sheets is 1 year. Therefore, it's very likely that the income statements we'll be looking at in the exam span 1 year of operations. Do they always have to span 1 year? Well, no, in certain situations they could be less than or more than a year, in particular when a company is changing its year end. But that's very unlikely for our exam. So typically, therefore, we're actually seeing the performance of a company over a period of 1 year. Now, what it's going to try and do is it's going to look at all the revenues, all the expenses, and all of the gains and losses. The idea is if we take the revenues, deduct the expenses, add any gains, subtract any losses, we get an idea of the company's profitability over that period. And we're going to define revenue, expense, gain and loss on a slide in just a second. So here we are. Let's define those terms that we were talking about with the income statement. First one up is our revenues. So let's have a quick read of what it says. They're inflows from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major central operations. Okay, so the key point is really, for it to be a revenue, it needs to be the sales generated from the core business operations of the company. In other words, it's the revenue generated from the key business operations rather than any incidental revenue that the company generates. Our expenses typically, therefore, are all of the costs of producing those goods and services and operating the company. So they're the outflows from delivering or producing goods. Often we refer to that as our costs of goods sold, but also all of the costs involved in running the company, operating the company that are not directly related to the production of goods and services, such as the accounting function within the company, legal fees, etc. So all the outflows from delivering or producing goods and services that are core to our central business operations. Now, we also talk about these gains and losses, and our gains and losses are typically profits or losses that we make that are not part of our core business operations. A good example for that might be that a company has decided to dispose of an asset during the year, and when they dispose of that asset, they're going to make a gain or a loss, a profit or a loss when they dispose of it, and that's treated as non-incidental. Why? It's not part of the core business operations of the company. It's not really what the company does on a day-to-day basis. So we try and show that separately. So good examples of gains and losses, therefore, we've said are asset disposals, early retirement of debt might be another example, and maybe things like restructuring provisions when the company is being reorganized. Okay, let's have a look at our next statement, and this is a little rarer maybe, a little bit, people are a little bit more uncertain about the statement of comprehensive income, a little bit less familiar with it. Now, the idea with our income statement is it shows all of the gains and losses that have been realized. However, in financial statements, some gains and losses can be taken directly into stockholders' equity within the balance sheet and they don't hit the income statement. So what the statement of comprehensive income does is it takes all sources of gain and loss for the shareholder, no matter where they've been reported. So all of the gains and losses, revenues and expenses that have gone to the income statement, but also any gains and losses that have been taken directly into stockholders' equity. Now, be aware that you can either show this comprehensive income statement separately as a separate financial statement, or it can be added to the bottom of the income statement. Okay, the balance sheet. Now again, a key primary financial statement here. Balance sheet, notice it says it's a statement of financial position. So very key to take away here is that the income statement and the statement of comprehensive income are really looking at performance over a period. The balance sheet is looking at the company's financial position. So whereas the income statement and the statement of comprehensive income were dynamic because they spanned a period of time, the balance sheet is often referred to as being static because it's as if the company is frozen at a point of time. And we're looking essentially at everything the company owns and everything the company is owed, being our assets. So let's put in owned and owed. Liabilities being the amounts the company owes to third parties. And owner's equity are amounts owed to the shareholders. Now the idea is if we take our assets, everything we own and are owed, deduct the liabilities, the amounts we owe to third parties, then what we are left with are the amounts that are owed to the shareholders. In other words, assets minus liabilities equals owner's equity. We're going to see that repeated a little bit later in a learning outcome that asks us to understand the balance sheet equation. Okay, so we can see actually balance sheet equation on the top of this slide, assets equals liabilities plus owner's equity. So this is why it's actually called a balance sheet. The process of double entry bookkeeping, and you'll be relieved to know we don't need to understand debits and credits for our exam, but the process of double entry bookkeeping means assets will always equal liabilities and owner's equity. What that means is if assets increase, either liabilities or owner's equity would need to increase to keep the balance sheet balancing. Likewise, if assets go down, liabilities or owner's equity would need to decrease to keep the balance sheet balancing. So as we said, assets are the resources controlled by the firm. They're everything the company owns. And when we say own, we're really talking about the long-lived assets of the company. Long-lived assets being the fixed assets, things like buildings, motor vehicles, plant and machinery, but also including things like intangible assets as well. Intangible assets, assets held for use within the business with no physical form. So we're looking at everything the company owns, but also everything the company is owed. So for example, maybe they've sold goods on credit and customers owe them some money. So assets, everything the company owns and is owed at the year-end date. Liabilities, as we mentioned, every amount that is owed to third parties. Now the definition of third parties is not the shareholders of the company. So these are going to be amounts that are owed to creditors of the company. Might be lenders, people we borrow money from, bondholders, could be other creditors like the tax authorities, etc. So we've got our assets, we've got our liabilities. Owner's equity, notice they're saying this is the residual interest in the net assets. What that means is if we take the assets, deduct the liabilities, anything left over, hey, well that must belong to the shareholders. Now our fourth key financial statement is the cash flow statement. Due to the accruals process, and we're going to touch on the accruals process later on, profit is not the same as cash. What that means essentially is items going through the income statement may not be made up of cash. So what that means is when we look at profit, we're not seeing the cash generated by the company. So we need a separate statement that shows us the cash that the company generated and spent during the year. Ultimately, of course, if a company is to go bankrupt, it's not because they run out of profit, it's because they run out of cash and can't pay their liabilities when they fall due. So a very important financial statement for us to be aware of. It's a dynamic financial statement, just like the income statement, meaning it spans a period of time between last balance sheet and this year's balance sheet. And what it's actually going to do is reconcile last year's balance sheet cash with this year's balance sheet cash. In other words, it's trying to explain how cash changed during the year. Now what it does is it looks at the change in cash and it divides it up into three categories. And we have operating cash flows or cash flow from operations, investing cash flows from investing, and financing cash flows from financing. Be aware, especially with CFO, it could be called in the exam a cash flow from operations, or it could be called an operating cash flow. Means exactly the same thing. Operating cash flows are essentially the cash that we generate from our day-to-day trading activities. Investing cash flows are typically the cash that we spend when we buy new fixed assets, when we buy investments, when we buy intangibles, but also includes the cash that we receive when we dispose of any of those. And financing cash flows, as it sounds, is typically focusing on the capital structure of the company. In other words, the cash that we raise when we issue new equity, the cash that we raise when we issue new debt or take out loans, less any cash involved when we pay off the principal. Fifth key financial statement is our statement of changes in owner's equity. Now, of course, owner's equity, another name for it you'll see in the exam, is stockholders' equity. Now remember, assets minus liabilities equals stockholders' equity. So what we're actually seeing in this financial statement is last year's shareholders' equity reconciled to this year's. In other words, we're looking at the change in stockholders' equity. So it's going to explain why equity has changed. Could it be that we've issued new shares? Could it be that we've bought back shares? Could it be that we've got some of these strange gains and losses that don't go via the income statement and go directly into stockholders' equity? In fact, gains and losses that are taken directly into stockholders' equity and that bypass the income statement are referred to other comprehensive income items. So it could be those. And of course, there is a link as well between the balance sheet and the income statement. And we're going to see that illustrated in a further reading a little bit later. But the basic idea is what we do is at the bottom of the income statement, we have that year's net income, net profit if you like. Then that gets transferred into the balance sheet within a line called retained earnings. So anything that affects the income statement will, by definition, affect the balance sheet via retained earnings in owner's equity. Okay, our next little learning outcome here asks us to describe the importance of footnotes and supplementary schedules. So let's have a look at what we've got. We've got some examples of footnotes here, typical footnotes. First two that we've got, basis of presentation and accounting methods and assumptions. Very, very, very key footnotes that you'll see in a set of financial statements. Basis of presentation is really telling you what accounting principles the company has adopted when producing their financial accounts. Now, of course, focus for us in financial statement analysis is we might be comparing two companies. We need to compare their performance. Therefore, we need to know how those accounts have been put together. Have the companies used similar accounting policies, or have they used different accounting policies, reducing comparability? Second point, the accounting methods. Well, again, that's talking about the principles and policies that have been chosen to display the financial data, but it also says assumptions. A common misconception with financial reporting is that it is a fact. All these numbers are known with absolute certainty. Reality is, with a lot of accounting standards, we're going to need to use assumptions and estimates. Now, where those assumption estimates are key, significant, and really affect the financial statements, they must be disclosed. So again, very important we look at these assumptions, especially when comparing between two companies, to make sure that we're looking at consistency, consistent assumptions before we calculate things such as ratios. Further information on amounts in primary statements. Well, the accounting standards actually give us a minimum amount of information that needs to go into the income statement, needs to go into the balance sheet, needs to go into cash flow statements, etc. Then what we'll typically find is more information on the amounts in the income statement and balance sheet and cash flow statement are given in the footnotes. So essentially, you might see just one line for current assets sitting in the balance sheet. You turn to the footnotes and look at current asset footnote. It will then tell you exactly what that line is made up of. This amount is the amount the customers owed us. This is amount of his inventory, etc. So we get additional information. Remember, the financial statements only set out a minimum amount of information that needs to be provided on the face of those financial statements, and the footnotes are going to give us greater detail of what's included. Acquisitions and disposals, so buying and selling new companies, again we'll see that stated in the footnotes. Contingencies. What is a contingency? We talk about contingent liabilities in particular. Now when we have a contingent liability, what we're really saying is we've got a liability dependent on a future event. Now a good example actually of a contingency would be legal proceedings. Maybe you're being sued. So you have got potentially a liability because you could lose that lawsuit and you might need to pay out. Issue is, we don't know whether we'll lose this lawsuit or not. So it's referred to as a contingent liability because the amount and size of it is dependent on future events. Stock options, benefit plans. Well, stock options, giving employees and directors the right to buy new shares in the company. It might be stock grants, giving them free shares. It might be stock options where we give them essentially an option on the company's shares. Benefit plans, well, the key benefit plan that we're going to look at a little bit at level 1, but we're going to expand dramatically on at level 2, will be pension liabilities. In particular, defined benefit pension liabilities. Notice information needs to be given on significant customers as well. This is to allow the analyst to actually have a look at the company and work out how dependent on certain customers are they. So for example, if over 50% of your revenue comes from one customer, well, if that customer leaves you, then the company is going to be in real trouble. Whereas if your revenue is split over many smaller customers, the company is not so much at risk. So significant customer information, quite important. Segment data, or known as segmental data. What are we looking at here? Well, typically when we look at the balance sheet, the income statement, the cash flow statement, we're seeing it for all group companies combined, aggregated across all of the company's activities. Now what that means is it's very difficult to compare different companies. If you've got a group company, a conglomerate with lots of different business activities, so let's take the Virgin Group in the UK. There's Virgin Trains, there's Virgin Airline, there's Virgin Healthcare, there's Virgin Financial Services, there's Virgin Health Clubs, there's even Virgin Brides, which actually turns out to be bridal wear. So you've got all of these companies combined in the profit and loss account, in the balance sheet. So it means it's very difficult to find benchmarks. It's very difficult to find other companies which you can compare the ratios that you calculate from Virgin's financial statements to. Now, the good news is if you are a conglomerate, if you have lots of different business activities, then you are going to need to present segmental data. What this is limited financial data for each individual division within your company. So the results of the train company, the results of the airline, essentially shown separately. And what that allows us to do is essentially calculate ratios using that segmental data and compare to other companies in that particular sector. So it's going to be very useful when we're trying to benchmark our ratios against other people within the industry. Quarterly data. Well, if you're a listed company, so you're traded on a stock exchange in the US, you need to produce quarterly data. Now, in Europe, it typically is 6 monthly data. Related party transactions. These are transactions between the firm and corporate insiders, such as key managers within the firm. Now, again, these have to be disclosed in the year-end accounts. Why? Well, because we want the shareholders to know any transactions between the company and key managers. Particularly, we want to be able to catch if the managers are selling themselves assets from the company way below market value. Well, it would show up here. So all of that information needs to be disclosed. Management discussion and analysis. Now again, this is the US phrase that you tend to get, and you see this in a set of glossy statutory accounts. Typically, you do see this kind of information within Europe and the rest of the world, but it often isn't called management discussion and analysis. So let's have a look at what's actually going on with this. This is information provided by the managers of the company. Now, unlike the financial statements and the footnotes, the management discussion and analysis typically is unaudited. What does that actually mean? Well, we're going to look at audit in just a second. What it means is there's been no independent check of the data provided in this information. So most common, it's not audited information. There is some exceptions, for example, Germany, where it is, but typically for our exam, we're meant to say it's unaudited. So what are they going to disclose here? Well, first of all, the nature of the business, a review of what the business does. What is its core operations? What is its core markets? Then, very key, they're going to actually review the performance over the previous period on a divisional basis. So they're going to go down and look at the operations of each division, talk about how each division has performed. Did it meet expectations? Did it have a poor year? What were the causes of that? What's likely to happen going forward? So a real overview of how the company performed. In particular then, on a divisional basis, we're going to go down and look at the sales in that division. Have they increased? Have they declined? And what are the reasons for that? Same with expenses. If they've dramatically changed period on period, then again, we'd expect to see some explanation of why that is the case. Okay, so we're going to look certainly at performance and the managers are going to give us information about performance and explanations behind that performance, but also they look at things like capital resources and liquidity. Now, whenever I see the phrase capital resources, I think, well, that's how the company is financing itself. It's capital structure, it's blend between debt and equity. So they're going to talk about, therefore, has the debt to equity blend changed? Have they issued new shares during the year? Have they taken out new loans? Have they issued bonds? Have they redeemed debt and equity? You'd see discussion of why that's taking place in the management discussion and analysis. Liquidity. Well, liquidity, we talk about solvency and we talk about liquidity. Solvency is really the ability to pay off long-term debt when it falls due. Liquidity is really your ability to pay off short-term liabilities when they fall due. So you'd see a discussion of that as well. The blend maybe between current assets and current liabilities. Cash flow trends, so a discussion of cash flow. Remember our components: cash flow from operations, cash flow from investing, and cash flow from financing. So again, any trends that have occurred in those, any significant changes year on year, any decreases, increases, would be explained away here by the managers. Discussion of critical accounting choices. In particular, if the company changes its accounting choices, and remember, when we look at accounting choices, we're talking about how transactions are reported in the financial statements. If they change their accounting choices, we would expect to see an explanation of why there has been a change. Now, essentially, a company is only really meant to change its accounting choices, its accounting policies, if the new policy more accurately represents the true economic substance of the transaction. So if there's been a change in accounting policy, we'd expect to see here a discussion by the managers of the company about why they feel that the new treatment better reflects the true economic substance. Notice as well, it's not purely backward looking in the management discussion and analysis. There's also an element of forward looking. What is likely to be happening to the company, its divisions going forward? So the effects of inflation, price changes and uncertainties on future results. Now we turn our attention to the audit report. Our LOS asks us to be aware of the objective of an audit report. Now, first of all, let's have a look at that first phrase. It's an independent review of the company's financial statements. Okay, independent review, meaning the auditors are not employed by the directors, the management of the company. Who employs the auditors? It's the shareholders that actually appoint the auditors, theoretically. Now, the idea here is we're trying to reduce agency cost. An agency cost is a phrase that will come up all throughout the CFA syllabus. We mention it in corporate finance at level 1, but it's a big topic in corporate finance at level 2. Agency cost arises because the shareholders own the company, but the managers run the company on a day-to-day basis. And every time the managers do something that maybe maximizes their own position rather than the shareholders' position, rather than the shareholders' if you like, we have an agency cost. So in other words, what we're trying to do is report back to the shareholders the performance of the company. Now again, a key point you need to be aware of here is that the managers of a company have the responsibility to produce the financial statements. So we need the auditors, therefore, to come in and check that those financial statements that are being presented to the shareholders are accurate. Okay, now let's have a look at that second phrase there. Reasonable assurance that the financial statements are free from material error. Well, let's focus on that first phrase straight away. Reasonable assurance. Doesn't say assurance. So it's not saying they're guaranteeing that there are no errors in the financial statements. It's a reasonable assurance. What that means essentially is they're using sampling techniques when they're checking the accuracy of the year-end financial statements, rather than checking every single item. Now the second point, it says reasonable assurance that the financial statements are free from material errors. Now that leads us to ask, what is a material error? Material errors are typically deemed to be errors that are so significant that they would affect the opinions of a user of the accounts. Now that then leads to the question, who defines how big an error needs to be to affect the perceptions of the users of the accounts? And the answer is to that, it's typically the audit firm. So notice with material errors, what they're not trying to do is verify that the accounts are correct to the nearest dollar. What they're doing is they're planning their audit to have reasonable assurance that they picked up on any errors that were significant enough that they would affect the opinions of the users of the accounts. They're not trying to check everything down to the nearest dollar, nearest pound. Okay, notice under US GAAP, the auditors have to do one extra thing as well. They need to provide an opinion on the company's internal controls. Internal controls are all of the checks and controls designed to essentially prevent fraud. Now, this is required under US GAAP as part of the Sarbanes-Oxley legislation, not required essentially under IFRS. So let's have a look at our audit reports. There are, essentially you can see, 4 types of audit report that we need to be aware for in our exam. Now, in reality, most companies, and especially if you're a listed company, you are hoping for an unqualified audit report, otherwise known as a clean opinion. What they're saying here is the audit firm are saying, in our opinion, these accounts are true and fair. In other words, they don't contain material errors and they accurately reflect the economic substance of the company in terms of performance and position. Now, if the auditors do find things that they disagree with during the year, so they might find a transaction and they disagree with the accounting treatment, they do allow, of course, the company to go back and restate the financial statements, correct their financial statements in order to get a clean opinion. So virtually most companies will have clean opinions. Now let's talk about unclean opinions, if you like, when we've got 2, qualified and adverse. Qualified audit opinion is often referred to as an except for audit opinion. Now what the auditors are saying here is largely the accounts are true and fair, represent economic substance, apart from maybe a certain transaction where the auditors do not feel the accounting policies reflect the economic substance. So there's an exception to the accounting principle. There's an exception to economic substance being reported. And again, what you'd expect them for in the audit report is the auditors then to detail that transaction and to detail why they believe the firm's accounting principles don't accurately represent economic substance. Now, as I said, if the auditors during the course of the audit do find something they disagree with, they do give the firm the chance to update their accounts, correct their accounts, if you like, to get an unqualified audit opinion. So this qualified audit opinion must be in the situation where the firm has refused to do that. They're saying, no, we're not going to adjust our accounts. Now, an adverse audit opinion, this is a kind of, if you like, the nuclear option. Here, what the auditors are saying is they do not believe the accounts are true and fair. It's not just simply a couple of transactions they disagree with. They believe that the accounts overall are not true and fair. They do not represent economic substance. In other words, there are errors, material errors, that pervade the accounts. So in other words, adverse, worst audit opinion you can really get, the auditors are saying, hey, look, these accounts are not true and fair. They don't represent economic substance. Now, the final one we should be aware of is a disclaimer of opinion. With a disclaimer of opinion, really what they're saying here is, look, they couldn't collect the data to make an opinion. They couldn't form an opinion given the data that the company had available for them. So they're refusing to make an opinion here. Sometimes you'll hear a disclaimer of opinion being referred to as a scope of limitation, and you should be aware of that phrase for your exam. So let's have a look at the audit report. 3 elements you need to know in an audit report. First of all, the responsibility of management to prepare accounts. Now, why is this being stated? Common misconception that a lot of shareholders will have is it's that the audit firm produces the year-end financial statements. They don't. It's the management team in the company that produce the accounts. The auditors therefore appointed by the shareholders to come in and form an opinion on those accounts and report to the shareholders. So they're setting out here, hey look, it's not our responsibility to produce these, it's the management. It also sets out the independence of the auditors. Remember, our auditors are appointed by the shareholders of the company, not the management. Now, typically that will happen often in the annual general meeting. What you typically find is it's the managers of the company, the directors of the company that will recommend an auditor is either appointed or removed. It's then the shareholders that get to vote on that resolution during the AGM. Second one, properly prepared in accordance with relevant GAAP. So in order for your accounts to be true and fair and to represent economic substance, number 1, they need to be free of material error, and number 2, they need to comply with the relevant GAAP. Now what does GAAP mean? Generally agreed accounting principles. And there are 2 forms of GAAP we're going to encounter in the CFA, US GAAP, which of course covers US companies, and IFRS, International Financial Reporting Standards, that pretty much covers most of the rest of the world. So here we're saying, well look, they have to be prepared with the proper accounting standards. Now if they're prepared with the proper accounting standards and of course are free from material misstatement, then you're going to get that unqualified audit opinion. Notice as well, point 3, the accounting principles and estimates chosen are reasonable. So not only is the accounting principle compliant with the relevant GAAP, but when it says the accounting principle is reasonable, then it's saying it not only complies with GAAP, but it properly reflects the economic substance of that transaction. Okay, so accounting principles reflect the accounting economic substance, but also the estimates. Now remember again what we said here is common misconception is that accounts are hard and fast fact and don't have any subjectivity. Not true. Loads of accounting estimates are going into their production, and therefore it's the job of the auditors to look at the estimates that have been made by the management team when preparing those accounts and to make sure they seem reasonable. Supplementary sources of information. We've got to identify and describe supplementary sources of information. Can't say I'm particularly excited by this as a learning outcome. Again, an awareness I think will do you. Quarterly, semi-annual reports. Remember we said if you are a listed company, then you're going to need to produce updates of your major financial statements, the income statement, the balance sheet, the cash flow statement, etc. Quarterly if you're US, semi-annual potentially if you're European. Proxy statements. I think this may be a little bit more significant. Every time the shareholders are going to vote in a company meeting, a proxy statement needs to be issued and also filed as well with the regulators. So what it's going to detail is it's going to detail what the shareholders are going to be voting on in the forthcoming meeting. So it might be election and removal of directors, it might be appointment or removal of auditors, it might be agreement of the management remuneration, granting of stock options, etc. Key point is by reviewing these proxy statements, we can see the key events, the key votes that the shareholders are making. Corporate reports and press releases, well, these are going to be written by management, therefore we need to be a little bit aware of bias in these. And we've also got economic and industry data from trade journals, reporting services and government agencies. Okay, so again, what we're really talking about is information that is out there in the written media. Our next LOS asks us to describe the steps for financial statement analysis, the framework. So again, really a series of steps to be aware of. again in the exam, what kind of question we like to see, which of the following is a step in the financial statement analysis framework? And we might be asked to describe what each step is. So first of all, step one, fairly straightforward. We're going to set out the purpose and context of analysis. In other words, the nature of the analyst's function. What are we doing? Are we evaluating equity for investment decisions? Are we evaluating debt for creditworthiness, credit ratings, etc.? It will also set out the purpose and context of analysis. We'll also set out the client's needs and concerns and any institutional guidelines that we have to follow. Okay, then step two is actually collecting the data. So this is essentially maybe collecting financial statements, maybe discussions with the firm's management, maybe actually visits to divisions of the firm. We then get to process the data. So processing the data, in particular in our financial reporting analysis, we're going to be doing that by computing ratios. Now again, this is a good point to mention. Financial statement analysis in the CFA, it's not financial accounting. They're not trying to turn you into an accountant here. You're an analyst. The idea is you're using this data, remember, to make decisions on whether to invest in a company, whether to issue, whether to loan to a company, etc. Okay, so processing data, what we're going to be doing a lot of is ratio analysis, comparing ratios between firms and comparing ratios over time. So that's our processing data. We've then got to analyze and interpret the data. Okay, so once you've calculated or processed your data, then what is it telling you, essentially? So that's our interpretation. Analytical reports, again, following any guidelines, so forecasts might come up here. Conclusions and recommendations, that's where we're actually producing our reports to the client and any recommendations. And again, we've got to follow any institutional guidelines here that we set out at step one. And then finally, update analysis periodically. Keep it all up to date. So really a list to learn.